Something big is happening in the silver market right now, and most investors are not fully understanding it. We are not just seeing normal price movement. We are watching a structural shift in how the silver market works. For years, the futures market was mostly a paper game. Traders bought and sold contracts, but very few actually wanted the physical metal. Now that is changing. And when that changes, the entire system feels pressure. Welcome to Gold Silver Scope, where we break down what is really happening in gold and silver in simple and clear language. The core issue today is the growing demand for physical silver. Industrial users are not slowing down. In fact, they are buying as much silver as they can get, often without caring too much about short-term price swings. They need the metal. Solar panel manufacturers need silver for photovoltaic cells. Electric vehicle producers need silver for electronics and battery systems. The defense industry uses silver in advanced military technology. This is not optional demand. It is structural demand. At the same time, something unusual is happening in the futures market. In the past, most futures traders did not want physical delivery. They were just speculating on price. They would open positions and close them before delivery month. But now, more participants are standing for delivery. They are actually asking for real metal. This creates stress because futures exchanges like the COMEX were designed mainly for price discovery and hedging, not for large-scale physical distribution. When more traders demand physical silver instead of cash settlement, warehouse inventories start to matter a lot. If inventories fall too low, confidence begins to shake. This is where talk of default risk starts appearing. Now, it is important to understand something clearly. If an exchange settles a contract in cash instead of metal, technically they may not call it a default. They can say, "We paid you the value." But for someone who specifically wanted physical silver, cash is not the same thing as metal. That difference is critical. Another factor investors must understand is price corrections. After a strong bull run, corrections are normal. Gold and silver have experienced powerful upward moves recently. When prices rise sharply, many investors sit on large profits. Some of them will sell to protect those gains. This creates temporary downward pressure. That does not mean the bull market is over. It simply means markets breathe in cycles. There is also the issue of margin requirements. Futures exchanges sometimes raise margin requirements during volatile periods. When that happens, traders must put up more money to maintain their positions. Some cannot afford the higher margin and are forced to close their trades. That reduces speculative activity and often pushes prices lower in the short term. This is not unusual, but it can amplify price swings. Right now, another temporary factor is affecting the market: reduced Asian participation. When major Asian markets close for holidays, liquidity drops. With fewer physical buyers active, the price discovery process becomes more influenced by leveraged futures traders, especially in the United States. Leveraged traders can move prices quickly in thin conditions. That can exaggerate both upside and downside moves. So what we are seeing this week is not necessarily a collapse in demand. It is more about temporary liquidity conditions and futures market mechanics. Industrial demand has not disappeared. Solar manufacturers still need silver. Electric vehicle production has not stopped. Military demand has not paused. The physical world continues to consume silver at a steady pace. The bigger question is this: what happens when global buyers return and physical demand meets a futures market that is already tight? That is where things become interesting. Because if physical demand remains strong and warehouse inventories are limited, the futures market could face increasing stress. This is not about panic. It is about structure. When a market that was built mainly for paper trading starts facing real physical delivery pressure, its weaknesses become visible. Short-term price weakness does not automatically mean long-term fundamentals are weak. Sometimes it is the opposite. Sometimes it reflects stress building beneath the surface. And that is exactly what serious gold and silver investors must understand right now. Now let us go deeper into what is really happening beneath the surface of the silver market, because this is where the story becomes much more serious. For decades, futures exchanges operated smoothly because very few participants demanded physical delivery. Most traders treated silver contracts like financial instruments, not as claims on actual metal. They were trading price movement, not silver bars. This allowed the system to function with relatively small physical inventories compared to the massive volume of paper contracts being traded daily. But today, that balance is slowly shifting. When industrial users start competing with investors for physical silver, the pressure builds quietly at first. Solar panel manufacturers cannot delay production just because the futures market is volatile. Electric vehicle companies cannot tell customers to wait because silver inventories are tight. Defense contractors cannot postpone contracts because of price swings. Their demand is structural and ongoing. This type of demand does not disappear during corrections. At the same time, more futures participants are beginning to question the reliability of paper claims. When confidence weakens, some traders decide to stand for delivery instead of rolling their contracts forward. That decision changes everything. Because once delivery requests increase, exchange warehouse inventories become critically important. If the exchange inventory is healthy, there is no immediate problem. But if inventories begin to decline while delivery demand increases, stress grows. Even if there is no official default, the perception of tightness can create a powerful psychological shift in the market. Confidence is the foundation of futures exchanges. Once confidence cracks, price volatility increases sharply. Now let us talk about margin requirements again, because this is a key mechanism. When volatility rises or when exchanges feel stress, they often raise margin requirements. This forces leveraged traders to either add more capital or close positions. In many cases, smaller speculators are pushed out. Prices fall quickly as positions are liquidated. On the surface, it looks like a crash. But structurally, it is often a cooling mechanism. Some investors view margin hikes as a way to control excessive speculation. Others believe it can temporarily suppress price momentum during periods of tight supply. Regardless of the interpretation, the effect is clear. Raising margins reduces futures activity and often pushes prices lower in the short term. Another important factor is liquidity concentration. When Asian markets are active, especially large buyers in China, there is stronger physical participation in price discovery. When those markets close temporarily due to holidays, the balance shifts. With fewer physical buyers active, leveraged traders dominate the price movement. Leveraged traders react quickly to news, technical levels, and margin changes. This can exaggerate downward moves, even if the underlying physical demand remains solid. This explains why we sometimes see sharp drops during thin trading conditions. It does not necessarily mean global demand has collapsed. It often means liquidity is temporarily one-sided. Now let us address the idea of default risk realistically. A full official default on a major exchange would be a historic event and would likely shake global financial markets. Exchanges have many tools to avoid such an outcome. They can raise margins, encourage cash settlement, adjust rules, or slow delivery pressure. From a technical perspective, cash settlement fulfills contractual value. But from a physical investor's perspective, cash is not the same as metal in hand. This difference between financial settlement and physical settlement is becoming more important in today's environment. When investors start preferring physical over paper, it signals deeper distrust in financial structures. That distrust can build slowly for years and then suddenly accelerate. Meanwhile, industrial demand continues in the background. Silver is not just a monetary metal. It is an industrial metal with critical applications in renewable energy, electronics, medical equipment, and defense systems. Global energy transition policies require massive solar expansion. Every solar panel requires silver. Electric vehicles require more silver than traditional cars due to advanced electronics. Even emerging technologies rely heavily on silver's conductivity. This structural demand creates a floor under long-term consumption. It does not guarantee that prices move up every week, but it means that dips often attract physical buyers. So, what we are witnessing right now could be a temporary correction driven by futures mechanics, margin adjustments, and holiday-related liquidity drops. But beneath that surface, physical demand remains strong. If inventories continue tightening while demand stays firm, price pressure can return quickly once global participation normalizes. Markets often move in cycles of tension and release. Right now, the tension is building in the physical side, while the futures side is experiencing forced cooling. When those two forces reconnect, volatility can increase again. Smart investors focus not only on daily price swings, but on structural supply and demand shifts. And the silver market is quietly undergoing one of those structural shifts right now. Now, let us complete the analysis by looking at the bigger picture and what investors should watch carefully in the coming weeks and months. The silver market today is standing at a sensitive point where physical demand and paper trading dynamics are interacting in a powerful way. When industrial users continue buying physical silver for solar energy, electronics, and defense technology, they create steady demand that does not disappear during short-term price weakness. That demand acts like a strong foundation under the market. At the same time, futures exchanges can experience temporary pressure when more traders stand for physical delivery. If warehouse inventories are declining and delivery requests increase, the system must balance carefully. Exchanges may respond by adjusting margins, encouraging cash settlements, or using other mechanisms to manage liquidity. These actions are normal tools in market management, but they often create sharp short-term price movements. Many investors misunderstand these price drops. They see falling prices and assume demand has collapsed. But in reality, price corrections often happen after strong upward rallies. When gold and silver rise significantly, traders who are sitting on profits sometimes decide to sell to protect gains. This selling creates downward pressure. It does not automatically mean the long-term trend has changed. In strong bull markets, corrections are natural and healthy. Another important factor to monitor is global participation. When major trading regions are temporarily inactive because of holidays or reduced liquidity, price action can become more volatile. In thin markets, even moderate selling or buying can move prices quickly. Once liquidity returns and more physical buyers re-enter the market, the price direction can stabilize or reverse. The deeper question for silver investors is about supply versus future demand. Silver production from mining does not always increase quickly because new mining projects require time and investment. If demand from industrial sectors continues growing while supply growth remains limited, the imbalance can tighten inventories over time. That tightening can create strong upward pressure when markets shift back into expansion mode. There is also growing awareness among investors that physical silver ownership provides exposure to real metal instead of paper promises. When confidence in futures contracts weakens, or when delivery discussions increase, more market participants start looking at physical holdings as a protection strategy. This shift in mindset can gradually increase demand for coins, bars, and allocated storage. However, it is important to stay balanced. Markets can remain stressed for long periods without any dramatic collapse. Exchanges have systems designed to prevent sudden failure. Even if settlement moves toward cash instead of metal in certain situations, that does not automatically mean the entire system breaks. It means the structure adapts under pressure. For long-term investors, the key is patience and risk management. Silver is known for strong volatility. Prices can move sharply up and down within short periods. Instead of reacting emotionally to daily price swings, investors should focus on fundamentals like industrial demand growth, inventory levels, mining supply constraints, and macroeconomic trends. In conclusion, the current situation shows a market where physical demand remains strong, while futures market mechanics create short-term volatility. Temporary corrections may provide opportunities for accumulation rather than signals of weakness. If physical demand continues rising and inventories stay under pressure, the longer-term outlook remains supportive for silver. Stay focused, watch inventory trends, monitor delivery demand, and understand that volatility is part of the journey. If you want deeper analysis like this, stay connected with us on Gold Silver Scope for more clear and practical breakdowns of the gold and silver market.